Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Mike Jones of Science, a startup studio and venture capital firm. Mike, thank you for joining us.
Thanks for having me.
All right. Can you tell us a bit about your background before you started investing in early stage?
Sure. So I'm a longtime internet entrepreneur and operator, and I started my career as an entrepreneur in high school and eventually formed my first company in college. And through that journey, I've run quite a few different businesses, going from startups that were started by me and a handful of friends to large enterprises like MySpace. And I even spent a whole stint inside of private equity. And through that journey, I got to know how to run and build big businesses and subsequently started Science with a handful of partners here.
Great. So we have a lot of investors that listen and always look for your advice. What would you tell those who are just now starting to invest in the early stage sector? What's your advice for them?
Sure. So I began doing early stage investments, I think after I sold my second company here in LA. And it was kind of in the year 2000. And I as a personal investor and angel, I did a ton of $25,000 to $50,000 checks into companies and founders that I knew and I understood. Over time, as an angel, I had some really great exits. I was involved with most of the large exits that happened in Los Angeles. But if I pull way back and look at that portfolio and that investing pacing, a few things are super obvious. One is that the companies I thought that were going to work seemed to never be the ones that did work. And the ones that I wasn't sure were going to work sometimes really work really well. So all that really means is you can do your best to pre-qualify these companies and pre-qualify these entrepreneurs, but you really do need to take a portfolio approach to this. I would highly recommend that however much capital you decide to put into early stage, you split it across a lot of different companies because it's really hard to pick the winner when you're investing in something at the very beginning stages of that business.
Well, I hear that. It's really hard to pick the winners for sure. But you've been doing this for a while, and you've probably seen the industry change quite a bit for investing in internet companies. And so how do you see the industry evolving today?
So, I mean, the venture industry or just the internet sector, like what part of the industry?
Let's talk about the internet part of it at this point.
Sure. So I think, as has been stated so many times by so many venture capitalists, technology has infused its way into every single sector. Technology is no longer technology, right? Technology is a component of innovation that happens into every company that's sitting on the stock market and every industry around the globe. What that basically means is that the opportunities for technology-enabled investors to invest are really, really vast. And I think that what you're really seeing that's happening every single day right now is the legacy businesses that originally started in a growth path, then they felt threatened and they went to kind of a profit extraction path, are now at a declining position. And so I suspect that over the next 10 years, many of the big legacy companies that we've seen grow and we grew up with will definitively start failing. Some of them will be intelligent enough to try to buy their way out of the problem through M&A. Some will attempt to innovate and change company culture and probably fail. But quite a few of them will move to a state where they're just trying to extract cash to provide some level of shareholder returns, then probably subsequently fail. So, you can spend a lot of time right now looking in the future and asking yourself which industries are not prepared to kind of fight the technology onslaught into their sector. And then you can bet, against them through funding startups that are probably going to disrupt their core business.
So as an investor, how do you manage that process? Obviously, it informs you on the opportunities, but what exactly do you look for when you're looking to invest on that thesis?
Investing is a few things. One is obviously there's understanding the personalities of founders and what makes great founders, which takes, in my mind, both being a founder that both succeeded and failed. It's a lot of personal knowledge, and then it's spending a lot of time with founders. So there's that personality component. But the second piece is just becoming, hopefully, one of the most knowledgeable people in whatever sector you want to focus in on. And that means for me, meeting with CEOs from large companies that are struggling, meeting with CEOs from companies that are acquiring businesses, and then spending a lot of time at the early stages, understanding the makeup of what early stage companies are attacking into that sector. And as I aggregate that knowledge together, I can build a thesis of saying, is this a sector that makes sense to invest in? What do I think the investment time horizon in is? How do I think about the future M&A events? How do I think about the pricing of M&A? And I can put that knowledge together and hopefully I can deploy capital successfully.
Are there any particular startups in your portfolio that really fit that thesis or came out well for you using that thesis?
Well, certainly. I mean, we had a belief 7, 8 years ago around the disruption of direct to consumer commerce. And the statement was really easy to understand. It was basically saying you've got these giant behemoth product companies in the world, and they don't know a name of a single customer of theirs, right? So their primary customer was the buyer at Walmart. The primary customer was the buyer at Costco, but they didn't actually know a customer. And our belief was that there would be brands that would approach this direct to consumer thesis and deliver a more personalized, connected relationship with the consumer through the web or through a mobile app. And in doing so, we looked for sectors where you had naturally reoccurring purchases, where if you convinced that customer that this was the right product for them and they had a solid and great product experience, that you would have a very loyal customer. And that's what kind of led us to doing Dollar Shave Club. So we believed heavily that this was a great area where the legacy players really didn't know who their customers were. They couldn't name you as a customer. We felt that there was a brand there, and we happened to connect with a fantastic entrepreneur that had a really big vision in the space. And we were lucky enough to partner with him at the early stages and both incubate and invest in his company.
So what are the challenges in starting businesses in this space? Where do you see the risks and challenges so far?
Well, I think starting businesses in this space or any space, the first challenge is always the management team. Who are they? How are they approaching this? What do they want to be when they grow up? How do they operate a business? Can they compellingly raise capital from other people? So you always have fundamental risk in the talent that are backing these businesses. But the second piece is there's certain sectors, especially in direct-to-consumer commerce, where there's just prohibitive cost to get to market, right? And that's something we think a lot about, which is saying, okay, even if you have a great management team, is it absorbently expensive to get this product to market and know whether there's a good fit? Are customers already satisfied with the current offerings? Is there really a moment of disruption, even if you have a passionate management team that wants to go after something?
Do you foresee any regulatory risks coming down now? They say that tech has become too big in some places and that security, privacy, and other issues are starting to come up. How do you see that impacting this space?
I think it impacts very little for direct-to-consumer commerce and brands, right? For large platforms that aggregate most of the world's daily internet audience, there's obviously a lot of discussion, right? And one way that I spend a lot of time working with different government agencies on how they think about things like privacy and user data. And one thing that became clear to me is similar to probably the early days of the stock markets, technology is a very complex industry, and it's really hard for somebody who is a newly appointed politician to become really well-versed in the complex issues and the complex systems that basically provide the infrastructure for all of our technology connection, especially around the web and data and people's content. So what that means to me is whether there's a regulation in the future or not, or deregulation in the future or not around internet or data or privacy, in my mind, the bigger question is what is the future government agency that will have the depth of expertise to truly understand the issues that face citizens in the US around technology? And how are they going to articulate and represent those problems and challenges and potentially future laws to the lawmakers? And I think that's actually needed more than just slapping a big note of regulation on top of it, because I don't think regulation is the right solution.
Well, it seems like it's currently in the FTC, the Federal Trade Commission. Don't know if it will stay there. What's your take? You think it's going to end up there as it is now, or do you think it's going to be broadened?
I think it'll be, I would imagine, similar to when the SEC was created, that at some point, regulators will come together and create a Bureau of Consumer Data Protection or Internet Connectivity Protection, or something where you have a group of deep, knowing experts that can understand these issues and provide guidance back to the companies and the consumers that are interacting. And I think that has to happen because the underpinnings of our technical systems are only getting more complex. And as you inject AI and other very complicated technologies into our daily lives, I don't think it's reasonable to think that just the FTC will have enough depth of expertise to understand these problems.
It does seem like they're a little bit overwhelmed and not prepared for the tech revolution, or at least now actually having to regulate it and monitor it in a bigger way. It's been small and growing, but now it's big and large, and so they have to do something different. So you're probably right. It's probably going to have to be specialized groups coming together to create new organizations because the challenges are very new from what it looks like today. But to switch gears for a minute, where do you see the immediate opportunities to pursue out there in the market today? There's quite a few opportunities. As you said, everything's being touched by the web, but what do you think is the low-hanging fruit?
I think there's themes that we think a lot about. We obviously believe that there's low-hanging fruit in direct-to-consumer relationships with brands, so we spend a lot of time there. One area that I think is obviously evident is that there's going to be a massive change as it relates to retail and real estate and the urbanization of our cities. So if you think to a future where you have way less in-person shopping, which means that you have a lot of open real estate in the city, and you also think towards a future where you may have substantially less direct ownership of stuff, and you may also have a very different amount of cars owned by citizens living in these cities, you start wondering, like, what do these cities look like? Like, do they need the level of parking? What happens to all this open real estate? What do landlords do if all their retail tenants start going out of business? If I'm getting a ton of food delivered, what happens to the restaurant industry? If I'm doing automated driving or I'm in safer driving environments, how does that impact healthcare locally? And so I think there's a change that will come to the makeup of our cities that can be invested in or arbitraged within the real estate sector, the delivery sector, the services sector. And so we spend a lot of time thinking about that.
That's great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I think it's worthwhile to note that you have a lot of really interesting IPOs that are suddenly happening. And I think there's this funny discussion where I feel like every day I read some news about an upcoming recession, and then every day I read some news about 4 or 5 massive tech companies doing monster IPOs. And today we had a big IPO with the Beyond Meat company, which is super exciting for another Los Angeles-based venture-funded startup. But I think it's interesting to watch these public markets because it feels like big new companies are being injected into that stock market and old companies are starting to kind of fall down. And maybe this is an interesting changing of the guard.
Well, that's great. Well, how best for listeners to get back in touch with you?
So I'm on Twitter at mjones, and I'm also on LinkedIn at mjones. It's pretty easy to find me. Our firm's website is science-inc.com, and we're happy to talk to investors and companies.
Great. We'll add that to the show notes and looking forward to having you back for a follow-up soon.
Sounds great. Thanks so much.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.